What happens when the paper market promises more than twice the metal that can actually be delivered? That question is no longer theoretical at COMEX. As of the latest vault report heading into the March settlement window, registered silver, the category that is warrant issued and immediately deliverable against futures contracts, stands at approximately 88 million ounces. Not rising, not replenished, flat. At the same time, eligible silver metal stored in COMEX vaults but not committed for delivery declined by another 1.2 million ounces in a single session, signaling continued physical drawdown beneath the surface. Now examine the other side of the ledger. March open interest remains near 222 million ounces. The arithmetic is straightforward. That leaves a gap of more than 130 million ounces between deliverable supply and outstanding contractual claims. Of course, not every contract results in delivery. Most are rolled forward. But that assumption only holds if the roll pace is orderly. Recently, the shift from March into May has been unusually slow, and with roughly 15 million ounces equivalent rolled in a session, while only a handful of trading days remain before first notice and settlement mechanics intensify. When time compresses, behavior changes. A structure dependent on voluntary rolling becomes sensitive to even marginal disruption. Flat registered inventories, shrinking eligible stocks, elevated open interest, and a slow roll combine into one reality. The risk of a delivery squeeze is not emotional, it is mathematical. If you value analysis grounded in primary data rather than headlines, subscribe to GB Economy. Pull the COMEX reports yourself. The numbers are public, and right now they demand attention. If the structural tension at COMEX is the foundation, then the next variable that could stress that structure is China's return to the market. Last week, during the Lunar New Year holiday, mainland China, one of the largest physical demand centers for silver globally, was effectively offline. Conventional wisdom suggested metals would stall without Chinese participation. Instead, silver futures rose nearly 9% week over week, moving from the high $70s to approximately $84 per ounce by Friday's close. That price strength occurred with Shanghai closed. Now consider what was happening beneath the surface. A major silver recycling firm in Shenzhen, one of China's primary precious metals hubs, was reportedly bidding around $93 per ounce for 9,999 fine silver heading into the weekend. That is roughly a $9 premium over Western futures pricing. This is not speculative leverage. This is a physical bid inside China, quoted while domestic exchanges were still inactive. The implication is straightforward. When the Shanghai Gold Exchange and related trading venues reopen, any sustained premium between onshore physical pricing and offshore futures could force rapid price alignment. Arbitrage flows do not wait politely. If Western paper sits at $84 and physical demand inside China validates pricing closer to $93, the spread becomes visible immediately. Link this back to the COMEX imbalance discussed earlier. A tight registered inventory combined with a reopening Chinese demand engine creates a feedback loop. Watch the Shanghai open. Watch the premium. Physical markets reveal stress faster than headlines ever will. If China's reopening is the short-term catalyst and COMEX inventory is the pressure point, the deeper layer is even more consequential. The silver market has been running a structural supply deficit for 6 consecutive years. This is not a one-quarter imbalance. According to industry data compiled by the Silver Institute, global mine production has averaged roughly 800 million ounces per year in recent cycles. That number has been relatively stagnant, constrained by declining ore grades, permitting delays, and capital discipline across major producers. At the same time, total demand, industrial, investment, jewelry, and silverware has consistently exceeded new supply. Photovoltaic demand alone has surged as solar installations expanded worldwide, while electrification trends continue to absorb incremental ounces annually. The result is a persistent gap that has required drawing down above-ground inventories to balance the books. Projections for 2026 indicate a potential deficit approaching 300 million ounces, which would represent more than 1/3 of annual global mine output. That scale is not statistical noise. It is structural strain. Deficits of that magnitude do not resolve through sentiment shifts or short-term dollar strength. They resolve through one of two mechanisms. Either supply rises materially, which requires multi-year mine development timelines, or price adjusts high enough to ration demand and incentivize new production. Neither happens overnight. Connect this back to the previous points. A tight COMEX deliverable category, a reopening Chinese physical market bidding above Western futures, and a multi-year global supply deficit form a layered imbalance. This is not a headline-driven spike. It is a long-duration mismatch between extraction capacity and consumption. Structural problems do not disappear quietly. They compound until repricing forces equilibrium. If a structural deficit is the fuel, then the behavior of major financial actors is the spark. Over recent months, approximately 13 million ounces of silver were reportedly reclassified within COMEX vaults, moved from the registered category, which is warrant issued and deliverable, into eligible, where metal remains stored but is no longer immediately available to satisfy futures delivery. On paper, nothing disappears. In practice, deliverable supply tightens instantly. In a market already carrying open interest multiples above registered inventory, that shift matters. The timing amplified the tension. Chinese industrial participants, accustomed to hedging exposure through Western futures markets, reportedly encountered difficulty when attempting to stand for delivery during a period of elevated demand. Whether framed as logistical constraint or inventory management, the outcome was the same. Access to physical metal was not frictionless. That friction is the signal. Simultaneously, reports from refining and concentrate markets in Latin America suggested intensified competition for raw silver feedstock. At least one regional producer indicated receiving bids materially above prevailing futures prices as buyers scrambled to secure supply. When upstream concentrate is effectively pre-contracted and downstream vault categories are tightening, it reveals something deeper than volatility. It reveals strategic positioning. This is why some analysts describe silver not merely as a commodity, but as a financial battleground. On one side sit Western bullion banks operating within the dollar-based derivatives framework. On the other, state-influenced demand channels seeking long-term material security. In an environment of multi-year structural deficits and visible vault reclassifications, silver becomes more than metal. It becomes leverage within competing monetary systems. And leverage, when constrained, exposes fault lines quickly. If the vault reclassifications and upstream competition revealed strain, the London lending market confirmed it. During recent stress episodes, LBMA silver lease rates spiked sharply, a signal that the normally quiet interbank lending network was tightening. In a functioning bullion system, major banks lease metal to one another smoothly, keeping short-term rates subdued. When lease rates jump, it means available float is no longer abundant. Liquidity is no longer assumed. At points of tension, lease rates moved well above their typical near-zero baseline, reflecting immediate demand for borrowed metal. That is not theoretical pricing. It is the cost institutions are willing to pay to access physical ounces in the short term. When bullion banks that usually transact privately begin sourcing more visibly, the informal cushion inside the paper system is thinning. This matters because London is the core hub of global over-the-counter silver trading. The LBMA clearing network underpins forwards, swaps, and large-scale institutional hedging. A spike in lease rates indicates that paper obligations are pressing closer to physical constraints. In other words, the derivative structure is being tested by material availability. When borrowing costs rise in a market built on leverage and rehypothecation, it is often the first measurable sign that physical reality is reasserting itself. Before drawing linear conclusions from tightening inventories and rising lease rates, it is critical to address the counterforces that can alter trajectory. First, the US dollar. A strengthening DXY index historically creates mechanical headwinds for dollar-denominated commodities. When the dollar appreciates, metals priced in USD become more expensive for foreign buyers, often dampening short-term demand. Even a 2-3% move in the dollar index over a compressed time frame can trigger algorithmic selling across commodity complexes. That dynamic cannot be ignored. Second, the Chinese yuan. A stronger yuan, particularly if it reaches its firmest level against the dollar since mid-2023, reduces the urgency for Chinese importers to hedge currency risk through metals exposure. When the exchange rate moves in their favor, the need to lock in dollar-priced inputs diminishes at the margin. This can soften physical premiums temporarily, even in structurally tight markets. Currency strength changes behavior, especially among industrial buyers operating on thin margins. Third, the supply deficit narrative itself requires nuance. Projections indicating a potential 300 million ounce deficit in 2026 are forecasts, not realized outcomes. Forecasts rely on assumptions: stable mine output near 800 million ounces annually, consistent industrial demand growth, and limited recycling response. Yet supply is not static. Higher prices incentivize expanded exploration, accelerate marginal projects, and increase scrap flows. Even a 5-10% uptick in recycling volumes can meaningfully offset projected shortfalls. In other words, structural imbalance does not eliminate cyclical volatility. Currency movements, profit-taking after rapid price advances, and adaptive supply responses can interrupt or delay repricing. Serious capital management requires acknowledging these variables rather than dismissing them. The presence of counterforces does not invalidate the structural case, but it does define the path. Markets rarely move in straight lines. They move through tension between opposing pressures, and understanding both sides is what separates analysis from advocacy. Even after accounting for currency dynamics and supply projections, one force continues to shape price behavior more than most participants realize: market psychology amplified through the paper system. A declassified 1,974 U.S. diplomatic cable openly discussed how expanding gold futures markets could make physical trading appear insignificant, increase volatility, and ultimately dampen long-term physical demand by influencing sentiment. That was not conspiracy rhetoric. It was policy-level recognition that derivatives can shape perception, and perception can shape behavior. Fast forward to the recent silver move. When prices retraced sharply towards $72 per ounce, sentiment shifted almost instantly. Headlines turned bearish. Social commentary flipped from structural deficit to collapse narrative within days. Yet the underlying data registered inventory levels, multi-year supply gaps, tightening lease rates did not change at the same speed. The structure remained intact. What changed was positioning and emotion. This is the defining tension of modern commodity markets. Futures volume routinely exceeds physical turnover by large multiples. That leverage amplifies both rallies and corrections. A 5–10% pullback in price can trigger algorithmic selling, margin liquidation, and retail capitulation, even if the physical balance sheet is largely unchanged. Paper volatility drives psychological reaction, and psychological reaction feeds back into price. The critical distinction, then, is between structure and narrative. Structure is measurable: vault stocks, open interest, lease rates, production data. Narrative is fluid, shaped by headlines and short-term price action. Serious analysis requires separating the two. Thank you for watching. If you see the data differently or hold a counterview, share your perspective in the comments. Constructive debate grounded in facts is how understanding advances.